So yeah, okay, but the fundamentals have not changed. The recession is here, or if we get a little breathing room, it's going to go down really hard this winter. All the problems we talked about.
The man behind the screen is a well-known financial advisor, economist, and New York Times best-selling author named Jim Rickards, who previously worked at Citibank, Long-Term Capital Management, and Caxton Associates. Since then, he's also advised many hedge funds, banks, and government agencies on strategy and risk management. Let's face it, the global economy is not in good shape. Many countries are struggling with high debt, weak growth, and negative interest rates. The financial markets are also turbulent, with stock prices gyrating wildly almost daily and bond yields falling to record lows. If you read the news or follow the financial markets, you will know that there is a crisis almost everywhere. There are recessions in individual countries like Venezuela, Argentina, and New Zealand, there is stagnation in Europe, and there is an economic slowdown in China and Japan. And this is just the beginning of our problems. In fact, a collapse is coming, everyone will be affected by it, it could arrive sooner rather than later. In this video, we will reveal why Jim Rickards says a collapse is coming, why it is coming, and what you can do to protect yourself against the consequences of this imminent global collapse. Please watch, like, and share this video. Also, drop your comments and thoughts below, and don't forget to subscribe to the channel for more related content similar to this. We begin with another short clip of Jim Rickards.
Fed pivot is a narrative, and it went like this. So inflation takes everyone by surprise in last fall, late 2021. November 2021, Jay Powell says, time to retire the word narrative. He actually said that in, transitory. He said, time to retire the word transitory. I think he said that in some congressional testimony. And then inflation goes to the roof, January, February, March, April. The stock market goes down. NASDAQ started going down actually in last November. Dow, S&P started to go down in January, and we're in a bear market by June. It's still going down. But then after the Fed raised rates in March, May, and June, and then the yield curves inverted, and some people weren't looking at them, but some people were. The narrative is like, well, wait a second. The yield curve inversion is telling us that rates are going to be lower 6 months from now. Inflation's cooling off a little bit, and it has. The price of gas has come down a little. And so they're going to have to cut rates. That was the pivot. They're going to have to cut rates in January, February, and rate cuts are good for stocks, so buy stocks. So then it's like, well, then we get this rally in July and August, and the stock markets, recovering a lot of this, not all the lost ground, by the way, but a lot of it in the stock market's rally, all based on the Fed pivot narrative, which I never bought into. I mean, you don't want to stand in front of a moving train. I wasn't going to short the S&P, but I did not buy into the narrative. I said for two reasons. Number one, oh, inflation came down from 9 to 8. Well, that's nice, but you say you want to get it to 2. You're a long way from 2. And how much demand destruction, how many rate hikes, how much do you have to do to really destroy the economy to get inflation down to 2? The answer is a lot. And tell me why that's good for stocks.
The world is on the verge of a financial panic. And by the end of this video, you'll understand why. The financial crisis of 2008 continues to have lingering effects today, almost 14 years later. Governments have printed trillions of dollars and other currencies to bail out their banks and financial institutions. Stock markets have surged, and real estate has come back with a vengeance. This has shown that the recovery that all occurred since the last crisis was false. You need to be worried about the current state of the economy because there are many warning signs that an economic crisis will occur soon. Listen to these carefully.
But the other reason is, and this is a little more sophisticated analytically, but just because the yield curves are telling you that market pros think rates are going to be lower, doesn't mean the Fed's going to cut. I mean, that is the message, but it doesn't mean the Fed's going to get the message. How many times does the Fed get things right? The answer is never. So I had, I think, August 26th at Jay Powell's Jackson Hole speech. I've never heard a Fed chairman, been following this a long time, never heard a Fed chairman use the word pain twice in the same paragraph, but he said, this is going to cause pain. It's going to be very painful. And then, so that kind of bursts the bubble of the pivot narrative. And then the stock market goes down, I think 6 straight days. You get a little, so what's going on now? I don't know. Maybe a little short covering, maybe, the buy the dips crowd have not gone away. They're still around. I'll say talking heads. I guess I'm one, but the cheerleaders, I'll put it that way. The Wall Street cheerleaders have never gone away. The Wall Street always wants to sell you something. The people who think the Fed knows what they're doing, there's some of those, a lot of those actually. And most importantly, Jay Powell told us, I always say that forecasting the consequences of Fed policy is really difficult, but forecasting Fed policy is the easiest thing in the world because they tell you what they're going to do. Yeah. You just have to listen and know. There's a little, so you need a decoder ring, there's some secret language, and you got to know who they always have a reporter du jour. There's one reporter that they leak to. In the old days, before they did this, there was primary dealer economists, great guys like Lacey Hahn and people at Aubrey Lanston and some of the lesser known primary dealers. The Fed said nothing publicly. They were a black hole, but they would leak it to their favorite primary dealer of the week. And you could kind of front run the Fed legally because they're part of the government.
Rickards believes that a financial collapse is coming and that everyone will be affected. He cites that even if the yield curve shows that interest rates are going to be lower, it doesn't warranty that the Fed is going to listen to such a message and cut down rates. He further said that it's difficult to forecast the consequences of the Fed policy, as they have the power to tell us all what to do, and we have no other option than to comply. He urges people to prepare for the worst and to be prepared to live without the comforts of modern life. Listen to these carefully.
Wall Street Journal. So if I read it in USA Today, I throw it in the trash. But if Nick Timiotis says 75 basis points, I'm like, okay, 75 basis points. That's right. But the hard part is what's going to happen as a result of that. And the Fed's thinking maybe hard landing, but not too bumpy. And I'm thinking more like a plane crash. Wishes they could keep out of politics. Now they can't and they don't, but they wish they could. And the last thing he wants to do is 75 basis points 3 days before the election. So 3 working days because they got the weekend in between. So let's just say 50, but you do another 50 in December. I mean, now you're at 4 to 4.25 range in 9 months. Yeah, that's extraordinary. They say too now, I read one analyst, he said, well, maybe we'll just get to 3. Well, first of all, Jay Powell's not saying that. And secondly, good luck getting to 3 without enormous damage and stuff, not to get too geeky, but sometimes I can't help myself. There's a concept, it's not that difficult. It's called DV01, which is the dollar value of 1 basis point. And what it means is if interest rates go up, whatever, 25 basis points or down 25 basis points, what's the change in the price of securities? And those, what's the rates up, prices down, rates down, prices up. That's just basic bond math, but it's not uniform or linear at all levels of rates. So when you at higher rates, the DV01 is lower, and at lower rates, the DV01 is higher, which means the impact of every basis point increase in interest rates is greater at lower levels, right? So in other words, raising rates from, I'll just say 2 to 4 for a range is much more damaging to prices than going from 8 to 10. 8 to 10%, much higher interest rates, a whole different world. But the impact of that on bond prices is less than going from 2 to 4, where it's like you're just putting these bonds in the cellar, and that plays out in derivatives world. So that's another factor, along with scarcity of collateral, shortage of dollars, quadrillion dollars in notional, deleveraging balance sheets, and a higher DV01, meaning these interest rate hikes do more damage per basis point to bond prices than if they were at a higher level. So far from saying, oh, we're low levels, who cares? It's quite the opposite. At low levels, that's when the damage is done.
A collapse is coming. It's not a matter of if but when. And when it happens, everyone will be affected. The economy will tank, social order will break down, and the very fabric of society will unravel. The signs are all around us. The economy is on the brink of collapse. Social unrest is growing. And the political system is in chaos. We are heading for a perfect storm. When the collapse comes, it will be sudden, and it will be catastrophic. The world as we know it will come to an end. And everyone will be affected. So what can you do to prepare? The best thing you can do is to get informed. Educate yourself on the signs of the collapse and what you can do to survive. Be prepared mentally and physically. And most importantly, don't panic. If you can stay calm and focused, you will have a much better chance of making it through the chaos. While there are many things that you can do to prepare for it, there are 3 key things that you must do. 1. Get out of debt. This is the most important thing you can do to protect yourself during a collapse. When the economy collapses, your income will likely decrease or disappear completely. If you have debt, you will be forced to default, and your credit score will plummet. This will make it very difficult to get loans in the future and could lead to legal trouble. 2. Build up a cash reserve. During a collapse, banks may close, and credit may freeze up. This means you won't be able to access your money when you need it. To prepare for this, you should have at least 6 months' worth of living expenses saved up in cash. 3. Create a food storage plan. A collapse will likely lead to widespread food shortages. To prepare for this, you should have a plan for how you will acquire food during the shortages. This could include stockpiling non-perishable items, growing your own food, or bartering with others who have food. Do you think we can avoid this impending collapse? If so, feel free to let us know your thoughts in the comment section below. Kindly share this video with your family and friends, and don't forget to hit the like button and subscribe to our channel for more updates. Thanks for watching.